So I just want to, first of all, say a sincere welcome. We are honored that you are here. Time is your most valuable asset, and the fact that you took some of your time to be with us, that is most appreciative. Thank you very, very much. We're going to be talking about some financial things this evening, and as I was thinking about that, it reminded me of a blonde. Okay? Now, if there's any real blondes in here, I apologize in advance. Okay? But this blonde, she woke up one morning, went to work, and unfortunately, it was conveyed to her that they were going to have to let her go. She was beside herself. I mean, she was really, really upset. So she went home and immediately she said a prayer. She said, God, I just lost my job, and I might even lose my house. Please let me win the lottery. As we all know, somebody just won, what was it, $1.28 billion in Illinois? So the next day, when she realized that she didn't win the lottery and someone else did, she prayed again. She said, God, please, I beg of you, I lost my house, my job, I lost my house, and I might even lose my car. Can I please win the lottery? Next day, she finds out, no lottery. So the next day, she's like, I got to try one more time. So she said, God, please, don't forsake me. I've been faithful. I've done everything I should. And pretty soon my children are not even going to be able to eat. And all of a sudden, lightning strikes. The heavens open up, and she hears this voice. Sweetheart, help me out here. Buy a ticket. So as I always say, it's all uphill from here. All right, so this evening we are going to be opening up with some financial topics that are all over the news, surely are on the top of your minds. Things like recession, markets have been down somewhat this year, even though they bounced back really sharp of late. And to be with us, Jake has been so kind to be able to share some very, very helpful perspectives on some topics with some very, very interesting slides. So with that being said, Jake, are you ready?
Ready to go. Let's do it.
All right. So let me get my market dropped about 20-some percent earlier. And NASDAQ was down, what, 30, 35? What's going on?
Yeah,
and
I think
bonds went down as well.
Well, that to me is really the interesting story of the year. The fact that, let's start with stocks.
Okay.
The fact that stocks dropped by 20% if you look at the S&P, a little bit more if you look at NASDAQ, global markets as well. That's actually not that unusual to happen in the stock market. I think really the story of the year is a little bit more around the bond market, and we'll get to that.
Okay.
But certainly you don't always expect your stocks and your bonds to go down at the same time. However, if you do look out there and you can kind of break it up by quarters and say, hey, how often would you see stocks and bonds down at the same time? You can go back to mid-1970s, and it's about 9 or 10% of the time that happens. So while it's not pleasant to go through, and certainly we don't expect it to happen every single quarter or to start the year, it's not completely unheard of for it to happen. Now, the stock piece of it being down 20% is kind of an interesting one in that it grabs a lot of headlines, but quite frankly, it's not that much of news. In fact, if we take a look at this slide, let me explain to you what we're looking at right here. This is going to go back to 1979, which is far back as we can take some of this data. And it's going to look by calendar years. And what you're looking at on the top part, that teal color, that's the largest gain during the year for this index that we're looking at right here. So for the US stock market, meaning at any point in time, that's how much it rose. The bottom, the kind of orange looking color right there, is how much it dropped in any given year. Now that doesn't mean that it was down that much for the entire year. That simply says that, hey, if I'm showing you a drop of 20% in orange, that could have been at one point during the year you were up 10% and then you dropped 20% to be down 10%. The interesting thing about this chart to me is that on average, you see a drop of about 14% in all of these years. So is being down 20 obviously more than 14? In any given year, you're down about 14% on average. Now, the question then is like, how often do we see this have an impact on ultimately the returns for the year? And what you see here is there's really no predictable pattern, meaning you get big drops, you get big ups. It's sort of what just happens in the market. In fact, look at 2020. We all know what took place in 2020. You got a major drop in 2020, you got a major recovery in 2020, and yet you're up substantially for the year. Now, Tim, to your question about the 20% being down, here's actually about how often you see that happen in these calendar years. So we're looking at roughly 40 plus years of data here. You got about 10 years there. So about 1 in 4, about 25% of the time, you get a drop of at least 20% in the stock market. You just happen to have it starting on January 1st this year.
And so, as we tell clients all the time, expect this. This is not normal. We don't know when it's going to happen, but you have to expect it. So when it happens, if we're supposed to expect that it's going to take place from time to time, why is it so hard for people to swallow that?
Well, I mean, I think, look, anytime it's never pleasant. As much as you tell yourself, oh, I know that markets go up and down, and we've seen it before, and there's going to be periods of high volatility and low volatility, losing money is not pleasant. I don't know anybody that enjoys ultimately going through that and losing money in their portfolio. A couple things to keep in mind is that markets do go up and down all the time. We've seen it historically, and if you want to be an investor going forward, that's going to take place. The other thing that I come back to is that why do you get a return as an investor? Fundamentally, the way that you get a return is you bear uncertainty in some form. You can call it risk, you can call it volatility, you can call it lots of different things, but you get a return because you're willing to bear uncertainty. If you didn't want to play that game, if you didn't want to bear uncertainty, you would get what they call the risk-free rate. You basically would get the return of cash. So when I see markets drop, it's not necessarily pleasant. I don't enjoy doing it. I don't like losing money in my 401k and my kids' college fund and all of that. But I also understand that that's part of the deal if I want to capture those long-term returns of markets.
Okay. All right. Yeah, it's as I try to emphasize, all declines are temporary. If you own a beautiful, diversified portfolio, while at the same time the advance long-term has been permanent, you know?
Up and to the right. Markets tend to go up and to the right, as I say, if you're looking at a chart. Let's also remember too is that if you don't need to sell tomorrow, it's just a loss on paper, right? And so you kind of stress yourself out when you look at your portfolio too often, when if you don't need to sell or make any change in it, you're sort of just putting yourself through unnecessary stress.
Yeah, and that's something else I often say is successful investing is 1% intellectual and 99% behavioral. But it's easily said, but it's not easily done.
Well, and it's easier said, and I guess internalizing that when things are going well, it's harder when you're actually going through it.
Yep. And having a financial plan that has been developed where these types of expected, although we don't know when they're going to take place, but these expected declines will occur, how important is that?
Well, I think it always comes back to the plan. You know, sometimes as investors, we like to look into the details and look at the value of our portfolio, and it's down, you know, the stock market is down 20%, and I lost a little bit of money in my bonds, and you know, you get concerned, you get into those intimate details of your portfolio, but really, at the end of the day, what are you trying to do? You're trying to put together a good plan. You're trying to feel good about your financial future. You figure out one that you can stick to, work closely with your advisor, and that's what it comes back to. So anytime that somebody gets a little bit stressed out about, my portfolio's down, or this underperformed, or that underperformed, I always come back to, are you on track for your goals? Because if you're on track for your goals, that is the number one priority.
Yeah, I think something else that really makes people uncomfortable is, although market declines are expected, and they've, as you said, take place about once every 5 years from a 20% or more perspective, the events around each bear market are unique. And so the rationale is, maybe this time it is different,
Well, we get this question all the time, and people want to always say, oh, this time it's different. And my immediate response is, yeah, it is always different. It's always different. The world is dynamic. The world is changing. Things are happening. There's different types of political events that are out there. It relates to the uncertainty, right? So yeah, it's different. But do the fundamentals do the principles of investing and those fundamentals that we come back to, do those change? And they really don't. We'll hit on recessions here in a little bit, and everybody wants to say, are you in a recession or are you out of recession? It's really hard to tell, as we'll show some data here in a little bit. And remember this, each one's different. The causes of them are different. The amount of inflation during it is different. The GDP growth, the unemployment, all of those look different. There's no cookie cutter recession that is out there. So whether it's a recession, or it's a global pandemic, or it's political events, or it's conflicts over in Europe, whatever, it's always different, but you can come back to some fundamental principles of investing. That's what gives you the best shot.
All right. What have we, actually you just went over that. So in our clients' portfolios, we use short-term and intermediate-term, predominantly government bonds. We have some investment grade, but most of it are governments. And as we express to our clients, we ideally like to have a minimum of 7 to 10 years worth of any planned expenditures, not in stocks, but in short-term, intermediate-term bonds, and obviously some in cash. Well, this year, stocks went down, yields on bonds went up, and I think it's been, there's only been 2 or 3 times in years that we've had both of those declining at the same time?
Yeah, no, it is. Again, you sort of think about, you have the discussion about asset allocation. What's in there? I got some stocks and I got some bonds, and each one's going to sort of play a role in there. And you think about the bonds of, hey, they should be a more stable investment inside of there. And while they're not going to have that long-term growth of stocks, they're going to hold up. And I get a little bit surprised when I see my bonds down. We actually can take a look at some of this data right here, which I think is, actually, we'll come back to that in just a second here. But the fixed income, or the bond piece of it, let's remember that they do fluctuate in value as well. Interest rates will change, and therefore the value of them will change. I said earlier about 10% of the time your stocks and your bonds are down at the same time. If you look out there and sort of say, well, how many quarters would bonds be down over the last 45 years or so? It's about 25% of the time. Actually, you do lose a little bit of money in your bond portfolio as well. It's less than the stock portfolio. And so while it may surprise you, it's not that abnormal to have your bonds be down a little bit in value.
In the short term.
In the short term. And that's important because, again, as you start to look out there and say, okay, well, do I need to sell my bonds today? Probably not. What you see is that they tend to recover, just like the stocks tend to recover after they go back. Let's also remember this. One of the arguments that we've heard for the last couple of years is, hey, yields are really low. I'm not necessarily getting anything on my fixed income. Well, you just said that yields have gone back up. So going forward, we actually look pretty good in terms of we would expect to have higher yields on our bond portfolio. So all of the things we've been concerned about for the last decade, while we lost a little bit of money, if we don't need to sell them, we're actually going to capture higher yields, higher income going forward.
Yeah, it's simple math when you have a bond fund and you have hundreds or even thousands of bonds in there, and they're all maturing at different times. As yields have gone up, they're able to reinvest those bonds in new bonds with higher yields. And if you look at the yield on your bond funds, they have actually gone up.
That's exactly right. And here's what it is, too. It's all about taking the intermediate to long-term approach. It's about sticking to the plan, because whether it's in the stock market or whether it's in the bond market, the longer you stay invested, the more you start to see those positive returns. In fact, if you look at some of this data right here, we'll start with the stock market piece of it. This is saying every time that you're down about 20%, what do you see? 1 year out, you got a return of about 20% positive. 3 years out, it's about 40%, and 5 years out, it's about 70%. So what you want to think about is that the longer that I can stay invested, regardless if I get a drop in my stocks or in my bonds, there's a high probability that I'm going to start to see those positive returns come back. This is looking at that stock market piece of it. And then let's take a look at this bond market piece of it. So I said earlier, about a quarter of the time you have negative quarters in the bond market. Well, as you start to expand that out from looking just at quarterly returns and looking rather at annual returns, you see a lot fewer negative returns there. So being a long-term investor and staying disciplined not only keeps you on track for your plan, each day that you stay invested, you're continuously putting the odds in your favor of capturing those good returns, even if you happen to have a period where you're down a little bit.
Yeah. Well, as we know, when you look back over the last 200 years, all declines have been temporary unless you choose to turn it into a permanent decline by selling.
It's like being on a roller coaster, right? I mean,
Yep.
it's a little bit concerning. I was watching a special actually with my kids recently on the world's biggest and fastest roller coasters, and you know that the only way you're going to get hurt on a roller coaster is if you ultimately get out of your seat. There's going to be a lot of ups and downs, and there can be some fast periods and some unnerving periods, but as long as you just stay in your seat, you're going to be just fine. It's very similar to investing. The way that you get hurt in the stock market or the bond market is you take an action that ultimately probably gets you out of the market, and then what's going to happen? That market can turn on you.
Yeah.
Look at what happened in July, right? Down first part of the year, we come to July, and it is up big, and markets will turn on a dime. And listen, the stress of being out of the market can be just as great as the stress of being in the market. You're watching markets go up when you're sitting on the sidelines. That is a painful thing to go through.
Yeah, it's on the radio, often I talk about, human nature is a failed investor because successful investing is so counterintuitive. As an example, when market prices have come down, their expected returns after they've come down are higher, which logically you would think, if that's the case, why should we not invest more now than we did maybe 6 months ago when things were up? But the way our brain and our emotions are wired, it really is counterintuitive. And without a plan and having discipline, it is very, very hard to follow through and execute,
It is. I got the question the other day. I was chatting with some people, and he said, are there any good things about a bear market? And one, I said, well, listen, you want to see markets go up and down when new information comes out. I mean, think about that. If you got information about company valuations or about political crises or about wars or a global pandemic, and you didn't see markets fluctuate in price, then you would be really concerned. Then you would say something's broken, something's not working. So when I see a market pullback of 10% or 20% or maybe even more, and it's associated with new news that's come out, that actually just shows me that markets are doing a great job of pricing that information. You would expect them to. The other thing to remember, and you're hitting on this, is it's an opportunity to rebalance. It's an opportunity to buy the equities, to buy the stocks at a little bit lower price in expectation that they're probably going to do well over time. So you never want to go through it. But bear markets are a part of investing, and they actually present some opportunities for you.
Yeah, and we are very, very firm believers in following that rebalancing discipline. And I have seen over the years, and I'm sure you have, so many people left to their own accord. Again, they know that they should rebalance, and maybe they should buy more while things are down, but trying to execute that on your own, it's tough. I mean, the emotions, because there's fear everywhere. It's all over the news. Low prices only really come about at great bargains when news is bad. And that's when it's hardest to invest.
And that's when it's hard. And the other thing, too, remember, at the bottom of the market, the news never looks good. You go back to March of 2009, how many positive news stories were you reading? Not very many. You go back to March of 2020.
COVID.
Everything looked dismal. You actually go to June of this year, you go back and start looking at market headlines, it is not a lot of positive news about investing. And then what happens? Boom, you're up big in July. The news is never good at the bottom of the market.
Yep. All right. Talked about bonds. Somebody mentioned to me the other day that maybe there's some inflation out there. How concerned should we be as investors, and with the Fed having raised rates several times, what does that mean for stocks? And I mean, how as investors should we adjust to that?
Yeah, so there's a lot of different pieces to unpack there. One, you've got the Fed and you've got what they're doing in terms of raising rates. And part of it is to get a hold of inflation. They're driving that, right? And then you want to understand, okay, so if the Fed does X, what does it mean for all types of bonds? You've got that part of it. If the Fed does X, what does it mean for inflation? And if the Fed does this, what does it mean for maybe my stock portfolio? So let's break all of these down just a little bit. So first I want to show you the Fed funds rate. And remember, it's rate, not rates. And I mean that people may even write in the media Fed funds rate. It's one rate that the Fed controls. It's the short-term lending rate. All other rates that are out there, and there's 400 or 500 of them if you look globally, those are set by market prices, not by the Fed. So this is what the Fed funds rate has looked like over the last couple of decades. And this is the 10-year US Treasury yield. Now it's interesting, you see some periods where you get some pretty big spikes in the Fed funds rate, and yet you still see something like the US 10-year rate come down. And Tim, if you look recently, the last couple of months, fascinating what's happened.
Yep.
You go back and we peaked at about 3.5% on the 10-year back in May, just before the first 75 basis point increase. Now we've had 2 75 basis point increases, and yet the 10-year has come down to 2.8. So you literally have these things moving in opposite directions. So will the increase in rates maybe have an impact on inflation? Probably, that would be the objective. But just remember, because the Fed does one thing, doesn't mean they control the entire bond market. That is set by so many other forces besides just one body that is setting a rate.
And if anything, when you look at the 10-year yield having come down from roughly 3.5 to I think it was 2.8 today, they're potentially anticipating a slowdown in the economy as the Fed has their mind set that they're going to keep jacking up short-term rates until things slow down. And then often, historically, when we go through slowdowns, rates don't keep going up, and if anything, yields on bonds, especially longer term, come down. And if you, God forbid, ever get into that time of deflation, you're going to love having your government bonds, you know?
That's right. And we'll go to some inflation stuff in a minute here. I think an overarching theme among investors is they want the signal that tells them when they get the good and when they can avoid the bad. We love this idea in our mind of the Fed is going to do this, right, and this is exactly what's going to happen with rates, or this is what's going to happen with the stock market, or this is what the Fed's going to do, and this is what's going to happen with inflation. As I always say, many investor questions are just market timing questions in disguise. They are literally, give me a signal on when I can get the good and I can avoid the bad. And I'm here to tell you, if it was that easy, somebody would have figured it out at this point. People are poring over this data constantly. Individuals they want to make money, they're greedy, they're looking for any edge they could get. And if somebody had that signal, I can promise you, it would have already been researched to death, right, and you would have it. It's not that easy.
Yeah, it's just, it's amazing how many times you hear people say or ask, well, with interest rates going up, does that mean I should get out of my bonds? As though the Fed causes yields on bonds to go up, but as you pointed out, and we've seen in the last several weeks, the opposite has actually happened. So, yeah.
Well, and that's an interesting question too. That's yields have gone up. Should I get out of my bond portfolio? It's like you already got hit on your bond portfolio. So if I were you, I'd capture the higher yields. But
yeah.
Yeah.
And if the prices keep coming down, you'll see the...
And prices go down. I mean, look, at the end of this year, somebody would tell me, hey, the 10-year U.S. Treasury rate is going to be at 4% at the end of this year. I'd say, that's completely plausible. And if someone said it's going to be at 1.7, I'd say, that's completely... You just don't know what's going to happen, right? So let's go in and let's talk some inflation, hit on some of that quickly here. All right, I love this little picture I grabbed right here, which is really what you feel every time you're going to fill your car up. Arm, leg, sole. I got 3 kids at home. Depending on how they're behaving, I may want to actually give them away. But so let's take a look at some inflation data. We get this question here of, hey, inflation's going to do X and therefore stocks are going to do Y. Or is inflation going to hurt my stock portfolio? And so what you're looking at right here is you're looking at the returns of the stock market, accounting for inflation. So this is the returns taking into account whether inflation, how it impacted there. And then in the yellow dots, what you have is you have inflation. And does anybody see any predictable pattern? Not really. It's tough to say year to year of inflation. Sometimes you get positive inflation and you see stocks go up, and sometimes you see stocks go down. Now, one of the questions we get is, hey, you're looking at some periods here with relatively low inflation. Okay, well, let's go back to a previous time period. We're looking at 61 to 90 here, and let's zoom in on a period that some of us may remember, 73 to 82. Pretty high inflation here in the US. For any of you that had mortgages or were dealing with interest rates, you remember this time period back in the 70s and early 80s. And look, you get some years, 73, 74, where stocks got killed. And then you get 75, 76 where they look good, and it's sort of up and down and back and forth. Main point here is that just because inflation is high doesn't mean that stocks are going to have good returns or they're going to have bad returns in any given year.
Yeah, it's when you think about it, hands down, and I think you have something on this, the best inflation hedge is long term, hands down, nothing even close, stocks.
Yeah, and we can dive into that. Here's the way I think about it. When I go and fill my car up with gas, or we're buying the kids back to school supplies right now, or we go to the grocery store or whatever, I feel the pain. I mean, all of you feel it. It's shocking how expensive things have gotten. And that's painful as a consumer. That's not the right question when you want to think about investing. The right question with investing is, what are my goals in relation to inflation? And what I mean by that is that if you say, hey, listen, I have spending needs that are coming up here in the near future, and those spending needs are sensitive to changes in inflation. Because there's always inflation expectations. What you want to account for is the change, the unexpected part of inflation. We just don't know what's going to happen. So if you have spending needs and you say, hey, they're really sensitive to inflation and I got to account for any unexpected parts, great. You know what? We have the tools to address that. There are tips, there are real return strategies, there's ways that you can say, yep, if that is my goal and that is my concern, I've got something to handle that. Now, if on the other hand, you say, it's not that I have to match unexpected inflation perfectly, right? My goal is to maintain purchasing power. I don't want to lose purchasing power, I want to outpace inflation. Well, that's great. We actually have the tools to do that as well. So what you're going to look at here is some pretty common investments that you can be in. And we wanted to say, hey, in high inflation years, how do these things do outpacing inflation? So this goes back to the 1920s. We're only going to look at the above median inflation years. These are the high inflation years. And we're going to look at how some of these investments perform. Now, treasury bills, short-term loans to the government, you can think about that basically as cash. You see a negative return. That's not a negative absolute return. That's saying after I counted for inflation, did T-bills keep pace? And what you see is that in high inflation years, treasury bills don't keep pace with inflation. You would have lost purchasing power by being invested in those. What about bonds? Well, they actually do pretty well. Again, remember, this is above and beyond inflation, because Tim, one of the things you hear is, hey, inflation's coming and I'm going to get crushed on my bond portfolio. Not necessarily what we've seen historically.
Right.
What about stocks? Pretty good. As you mentioned, you want to address inflation, we got a great tool to do it. And then you've got some subset of stocks, large growth and small value. But the main point there is that it's not pleasant to deal with 9% year over year inflation. We all feel it, but as investors, you got the tools to address it regardless of what your goal is. You know, Tim, I work a ton around the house. I love doing projects. I got a great workbench. It's always been a hobby of mine.
You can stop over at my house then.
That's what a lot of people say when I do that. But when I walk out to my workbench and I know the exact tool to use for the project that I have to accomplish. I literally get a smile on my face. And I think about it the same way. Inflation is something we have to address as investors, but we have the tools to address it.
Yeah, and just for the benefit of everyone here, in our stock funds and our stock portfolios, we do tilt a little bit more than what you would get like in a total stock market index fund or an S&P 500 fund to those last two categories there, the small and the large value. So I just wanted you to know that.
Yeah, so it's interesting data to look at. I mean, conceptually you know it, but I was happy when we ran this analysis. And again, I was happy we looked at the above median inflation years. Because listen, when inflation is 2 or 3%, nobody asks any questions about it. It's when it's 7, 8, 9%, that's when they ask questions about it.
Yep. Okay. The R word. Do you know what the R word is?
I do know what the R word is, yes.
Everybody here probably knows what the R word is. People are arguing, technically we've had 2 quarters negative decline. That has to be definition of recession, and then they go, to the NEBR or whatever, it's the National Bureau of Economic Research, and that's not exactly what that says, but I think it's irrelevant as an investor what the actual true definition is. I think there's some political motives behind all of that. But talk to us about recessions, how markets react when we have recessions. Have they historically gone down? Do they go down at the same time? Do markets perhaps move in advance? What are your thoughts on that?
Yeah, it's a good question. You're right about that there is the technical 2-quarter definition, but really it comes down to a group of economists that get together and look at a number of different factors. As investors, it's interesting to read the headlines and think about it. It doesn't really matter for us. Once you're having the discussion, and all of you are probably asking questions about it or talking about it or reading articles about it, and once it's out there, it's already in stock prices. In fact,
it's priced in. Yep.
It's priced in. How many people in this room think that we're in a recession? Show of hands. Okay, third of the room. How many people think we're not in a recession? Not everybody participated. That was not fair. Let's try that one more time. How many people think we're in a recession? Be honest. How many people think that we are in a recession right now in the U.S.? Okay, about half. How many people think we are not in a recession here in the U.S.? It's about half the room. I mean, that's what makes a market right there, right? You got buyers and sellers coming together. Everybody's got an opinion. But here's what matters for us as an investor. Let's go in and let's dive into this. So I want to take you back to 07, 08, 09. And this is back in the global financial crisis. We probably all remember this. And this is looking at the U.S. stock market. We know that we had a pretty big fall off in the U.S. stock market, down about 45, 50%, depending on where you looked. Now, this is kind of interesting. This is when we were officially in a recession, December of 07 through May of 2009. Now, let's see when we actually found out officially, we got the official announcement that we were in a recession. That didn't come until a year later, in December 2008. Now, the official announcement that we were out of a recession came all the way out in September of 2010. Now, look at that kind of faded green box. What's happening with markets during that period? Which direction are they going? They're going down. Markets, the stock market doesn't sit around and wait for an official announcement. Once all of you are discussing it and you're reading articles about it, that is in market prices, and the stock market is probably already dropping. And then look what happens. You're well on your way to recovery before we get an announcement that we are officially out of a recession. Now let's go back to 2020, and let's look at this. This is looking at 2020. To Tim's point, the official definition of recession is 2 quarters of negative GDP. That did not take place here because you only had a 2-month recession, February of 2020 to April of 2020. Again, look at what's happening in markets. Market participants were not sitting around in February and saying, I wonder if there's going to be a downturn based on this global pandemic. You know what? Let's just sit around and wait for an official announcement, because that announcement didn't come until June of 2020, and the announcement that we were out of a recession didn't come until the following year. So it's an interesting question. Yes, it could impact us. It could impact the economy. It could impact jobs. There's a lot of different things that could happen there. But as investors, it's already in the price. And so trying to predict, are we in a recession, are we out of a recession, and should I do something different, that's a slippery slope to go down.
Yeah. Yeah, it's, as we know, and sometimes forget, markets look in advance, but by the time it's news, it's not news to the markets anymore because everyone is obviously aware of it. So that's good.
Everybody's aware. In fact, one other data point that's kind of interesting, in April, after the market was already well on its way to recovery, we got the announcement, I think it was 14.1% unemployment. And we were getting questions of, hey, all of this news that's coming out is really negative. How the heck is the stock market going up? All of that was already expected by the market. We knew that unemployment was going to be bad. We knew we were going to be in lockdown. We knew that there was a bad thing coming, and that's why markets dropped 30% in a matter of weeks.
Yeah.
So once all of that information's already out there, market can get past it and well on their way to recovery.
And market returns so often come in short spurts.
Short spurts.
You know, when we talk about average returns, we have to remember that most of those returns happen, as I've said, during very short time periods. And if you miss out on those, that can really negatively impact your returns.
I mean, it's a classic thing of going to, kids' sporting event. Again, I got 3 little kiddos. I got Barkley, I got Maya, and I got Mabel. Barkley plays flag football. You sit out there all day on a Saturday. It's hot down in Texas. You get up for 1 minute to go get a bottle of water from the car. What happens there in that minute? Barkley scores a touchdown. And that actually happened. And that's what happens in markets, right? I mean, if you're not in your seat, if you're not there all the time, you're going to miss out. In fact, this is pretty interesting data to me. So this to me will really drive it home because this will make it real. Okay, so this looks at the last 25 years and said, hey, if you stayed invested over this period, over 25 years, you would have gotten about a 10% return, which, by the way, is about the long-term return in markets. Now, let's imagine that you miss the best week in the market, just the best 5 days. And I love the way that this is done because sometimes you see this analysis that says, hey, over the last 80 or 90 years, if you missed the 5 individual days in the market, your return would have been cut in half. Nobody is that unlucky. You couldn't have picked those 5 days if your life depended on it. What this does is say, no, consecutive days of being out of the market. So the best week is 5 trading days out of the market. That could be, I was out of the market Wednesday, Thursday, Friday, Tuesday, Monday, Tuesday. You get the idea. Same thing with the best month, 3 months, 6 months makes it consecutive. You miss the best week, you lose about 1% on your return. Okay, not bad. Let's actually turn this into dollars of what that would have meant. So your 10 million bucks, that'd be nice to have 10 million bucks. Your 10 million bucks now just got turned into about 8.5 million bucks just because you missed 1 week of being in the markets. How about the best month, the best 3 months, the best 6 months? Look at the best 3 months. You just took your 10 million and you turned it into $7 million because you wanted to get out of the market for a short period of time. Now, let's make this very real for everybody in this room. Let's put some dates to this. Look at that best 3-month period. This is not some analysis from 80 years ago. We just went through this as investors. And you know there's people that in March of 2020, without the help of an advisor, left to their own devices, got out of the market. They very well may still be out of the market, but even if they hop back in mid-year, they took 10 million and turned it into 7 million. That's real money right there, and it's so hard to stick to the plan a lot of times when you're on your own because those emotions will start to creep in.
And it's not just the money that you missed, it's the future compounding of what that money would earn.
100%. 100%.
Yeah. And we saw this as recent as the month of July.
Yep.
What markets were up 10% or so?
Yeah, I mean, we were
July?
down, everybody was talking about, down 20%, worst year since 1970. Everybody was citing all of that. And then you look by August 1st and, a global stock portfolio's down 11%. So you got 9, 10, you almost got half of it back in 1 month. Yeah. And again, what were the headlines around June 30th, July 1st? They were not positive.
Here comes the recession.
Yep, that's right.
Yeah, in fact, I think in July, most of that happened like within the last 10 days of July. I mean, that spurt that we were talking about,
The long-term return of markets happens in very short periods of time. A lot of the time in markets, it's boring. It's just kind of going along. You hit some periods of volatility, it gets a little tough, but those big pops, so the long-term return is really captured in a very short number of days. It's the same thing for individual stocks. If you look at the stock market in any given year, it's a handful of the companies that drive the overall return. And if you don't happen to pick those individual stocks, you're going to miss out on the majority of market returns.
Yeah, reminds me of that study by Hendrik Bessenbinder out of the Arizona State University when he went and looked back at all the stocks ever been listed. And when you look at the returns, the 9 or 10% returns of markets long term, that research showed that only about 4% of all the stocks carried the weight of all the others, where as a result provided those high returns. So if you would have missed out on just holding that small amount of stocks, your returns would have been, I think it was something like most of the returns were equal to treasuries. So.
Well, and that's why it becomes so attractive, because whether it's being out of the market at the right time and in the market, if you did it correctly, the returns you could amass on the money are so astounding. It's the same thing with picking if you could pick the individual stocks that were ultimately going to drive home the return, it's so attractive to do, and that's why, and it's sad to see, that's why people just year after year keep doing it with really detrimental results.
Well, it's because again, it comes back to how our brains are wired. We want to believe that there's got to be somebody out there that has the secret sauce, and that's why there's so many newsletters sold. That's why, financial news, people are just watching it in hope of surely somebody can show me what the way is to avoid the pain and still get returns. And it doesn't exist.
It just doesn't exist.
And the evidence shows that.
And the evidence shows it, but it's human nature, right? The smarter I am, the harder I work, the more successful I'm going to be in almost every aspect of my life. Investing is not that. It's just, there's too many people playing the same game. Markets are too competitive, everything is in price, and by the way, new information comes out literally every single second.
Yeah, I would say that probably the most important attribute that you need to be a successful investor is to start with humility. Saying that I, nor you, nor anyone else can reliably predict in advance what interest rates are going to do, what markets are going to do, and thus the answer is we diversify. Yep.
Best thing to do.
Okay, I think we got time for one more here. Let's see here. What might we want to end this on? International investing. So over the last decade or so, international markets have provided decent returns, but here in the U.S., it's been on a tear. Does international investing still make sense? And if so, why?
Yeah, so I'll look at it from a couple different angles. As an investor, what I'm trying to do is I'm trying to capture the returns of global capitalism wherever they take place. Listen, there are, and we've run all types of studies on firms, we've run studies on investors, people all over the world and companies all over the world are looking to take natural resources and good ideas and hard work and put it together and take a little bit of money and turn it into more money for their investors. That takes place in every single country, almost every country, around the world. As an investor, I just want to capture those returns wherever they're going to come from, regardless if it's in the US or it's outside the US. Now, there's going to be periods where the US looks good and investing outside the US doesn't look so good. But there's also plenty of periods where that looks different. You cited the last 10 years or so, and US markets have looked really strong relative to a global portfolio. Interestingly enough, global portfolio has actually done above its long-term average the last 10 years, so you were just fine staying on track for your goals. But if you go back to the previous decade, that 2000 to 2009 time period, Tim, it's literally the exact opposite story. So if you were standing there in January of 2010, it would not have been, hey, why don't you have me more in the S&P 500? Hey, why don't we get some more of those FANG stocks, those big US tech companies? It would have been, why the heck do I have so much of this US stuff? Why didn't you have me more in emerging markets and more in international? So we always want what's done well recently. There's nothing that we see that would say somehow that global investing doesn't make sense. And in fact, if you look over the last 21 years, and you look at something like the S&P 500 or even the NASDAQ and how that did over 21 years, and then how a global portfolio did over 21 years, the global portfolio actually beats it by about 1% annualized over that time period. And interestingly enough, a 60-40 portfolio, so 60% stocks, 40% bonds.
I thought that was dead.
Nope, that's still alive. That actually outperforms US stocks as well over that 21-year period. So listen, we're always going to have these runs where something does well. And once something does well, people want more of it in their portfolio. But if you just extend the time period a little bit further, you apply some logic of capturing global capitalism, I think there's an incredibly strong case to be made for staying invested outside of the US.
And going back to what we were talking about earlier, when you look at the valuations, due to the fact that US markets have been on a tear over the last decade or so relative to international, the valuations for international markets are more attractive because their prices have remained lower, which means what for future expected returns? They're higher than they are in the US. They're not guaranteed, but the expected returns are higher because they're at more of a discount relative to their historical prices.
Yeah, that's right. I mean, we would never make any type of prediction about the future, but it is interesting to look at the data. And if you go back to sort of the 99-2000 period and you look at, hey, where was, as you mentioned, the valuation of US markets compared to non-US, we're actually in a pretty similar period right now in terms of the valuations of US have gotten pretty high. Doesn't mean they're not, they can still have good returns going forward,
right,
but it shows that, hey, those emerging markets and those international developed markets all around the world certainly do have a much lower valuation relative to what we see in US markets.
Okay.
Sorry, Tim, let me give one more point too.
Sure.
And just, when I think about diversifying globally, I like to think simply of the products that I experience. Think about cars. Which cars are made here in the US? Obviously, you've got a number of companies. But is the US the only producer of cars? Not at all. Korea, Japan, India, UK. Cars are produced all over the world. And so that happens with many different products. So if you said, hey, I believe that automobiles are going to be a part of the global economy and they're a portion of global capitalism going forward, why would I want to just own US car manufacturers when we know that there's cars produced all over the world? Now also think about all of the cars that are produced here in the US. Where are the parts made? All in the US? Nope, they're not. In fact, even for US companies, the vehicles aren't even all produced in the US. So we are an interconnected global economy, and all I'm trying to do as an investor is capture my fair share of those returns regardless of where they take place.
So with the news that's going on right now, which everyone's aware of, we got China, we got Russia, we've got potentially Taiwan. Should that impact how we invest? Or as you were saying earlier, if I know it, you know it, our clients know it, millions of other investors know it, is that accounted for and reflected in market prices where they're at right now?
If you're talking about it and you're reading an article about it, that information is incorporated. Now, some people may say, we did that, how many people think the recession's here, and we got about a 50-50 split. That type of stuff's taking place in markets all the time. The information's out there, and some people think, hey, we've got issues going on in China, and we know what's happening with Russia and Ukraine, and I'm really concerned, and I'm a seller. Great. For every seller, there's a buyer. There's another person that's sitting on the side of that trade that says, yep, I know that information as well, but prices have fallen to a level where I'm perfectly comfortable buying. And this is taking place in markets all day long. So just remember, if you're talking about it and you've read it, it's already in the market price. People are already trading on that information. Let's also come back to a point I made earlier. Why do you get a return? You get a return because you bear uncertainty. And so what's going to happen with the situation with China and Taiwan? I don't have a clue. It's uncertainty. What's going to happen ultimately with Russia and Ukraine? I don't know. Where's inflation going to go? I don't know. Are we in a recession? I'm not sure. It's all just uncertainty that's out there, and that's what you have to deal with as an investor if you want to get the returns.
Can you speak just about 2 minutes, and then we're going to wrap it up for Q&A. Politics. Oh.
No, I do not talk politics.
So we got November coming up. There's a lot of things going on with politics. How should investors incorporate that into how they invest, or should they account for that at all?
I think you want to be very careful letting your political views flow into your investment decisions. Certainly, I mean, I love being in America. I love a democratic society. Get out there and vote. Whatever your political view is, whatever you care about, for sure, we need to see voter rates get up. I tell it to my kids all the time, like, you have to get out there and express your views through voting. Whatever you believe, that's your choice. But then taking that and saying, well, because this party that I don't like is now in control of Congress, or is the president of the United States, or whatever it may be, that somehow that's going to be a clear signal that markets are going to go up or markets are going to go down. Again, it's just not that clean. You start to look at Democratic-controlled Congress, you look at Republican-controlled Congress, you look at mixed control of Congress, and you look over longer time periods, and what do you see? Markets tend to go up and to the right. You look at who's in power in the office, and whether they're going to have positive returns or negative returns, you just can't come up with some clear pattern. Because think about this. Does the President of the United States have an influence on stock prices? In some small way, probably. Probably everything has an influence on stock prices. But what else does? Economies all around the world, and what's happening with inflation, and what's happening with conflicts, and what's happening with innovation at different companies, and investor preferences, and all of these things. So to say there's this clear link between this party is in control and this is what's going to happen in the stock market, that is such a muddy argument, and the data doesn't support it.
I was going to say, there's no evidence.
There's no evidence.
In
But
fact,
again, you can go express your views.
No, absolutely.
And what I always say too is, if you have such strong political views, there's probably opportunities for you to try to maybe align some of your, meaning you care about something that is really important to you. Have a great conversation with your advisor of, I get it. Is there anything we could do with your financial plan long term that aligns with that? But we're not going to make a change with our investments just because you're going to get a shift of control in Congress later on this year.
Right, right. All right, let's open it up. We have two microphones. Lori's going to have one, and Christine is. And they're in the back. So if you have anything that you'd like to ask me or Jake, raise your hand, and please wait till they run up. Hopefully they won't trip in their heels and hand you a mic. So anyone?
Here we got one right there in the center.
To stand or just sit? Recently, last couple of months, been hearing a lot about a ESG, and just wondering what your thoughts on it is. Is this something to be concerned about? Do you think it'll impact in any way, or is it really won't amount to anything?
You want to take that one?
Yeah, and then you can add.
Yeah.
When you say you've heard some things, can you be a little more specific? Because just for the benefit of everyone, there's a type of investing that has been coming out. It's called ESG, which stands for Environmental Social Governance. And essentially, it allows you to invest in certain ways subject to your social beliefs, and somewhat your political beliefs, environmental beliefs. So can you please be a little bit more specific, please?
I think, from what I understand about it, is it's going to score businesses based on what their carbon footprint is, and that score could impact what type of rate they get for loans, perhaps from investment banks. So I'm just wondering if you think this will have some impact on the market's investments down the road at all.
Jake?
Yeah, so it's a great question there. I want to start off by saying I don't think that those three letters should be grouped together, just for everybody in the room. They're three really different things, right? Environmental. Okay, I'm concerned about the future of the planet, and I want to understand what companies are doing, and can we invest in a way or with companies that are taking more of a stronger stance there? Great, that's an environmental piece. Social. Historically, that was really religious screens that were put inside of the portfolio. It's expanded into more social issues that are going on outside of there. And then governance, the G, that's just good shareholder management. Meaning at Dimensional, we take G incredibly seriously because our objective is to maximize shareholder value, which is all of you. So when we see something that's taking place at a company and we don't like something on executive compensation or the way that the company's being run or something, we're gonna take a really strong stance because if we do that well, that enhances returns for all of you. So that's what I'll say. They really should be broken apart. Now, to your point there of companies are now getting scored on their carbon footprint, and that could ultimately impact their business operations, their access to capital, whatever it may be. There is some of that taking place, but you're also getting a ton of pushback because the data is so incredibly muddy on how you actually should score this stuff. If you go out there and you look at some of the biggest companies that are doing these environmental ratings, you could look at a company like Tesla. And in one company's rating, they'd say, oh, they're out there saving the world. Look at all these electric cars. It's going to be the greatest thing. But then another one's going to say, whoa, 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 hold up. Let's go back and let's actually look at their factories. Let's look at their supply chain. Let's really go much more upstream on what the impact is. And they're going to come up with a completely different rating or scoring for Tesla. So is it something that we should be monitoring? Certainly. Is it more of a news story? You bet. But right now, you're actually getting even more of a pushback on some of the ratings and scoring that are coming back because people are saying, look, how much of this data can we really trust because nobody's got a consensus on how we should even score this stuff.
It's very subjective.
Yeah.
Yeah. All right, anyone else? Hey, Lori, have somebody up here. Here at the second table. And we'll take maybe 2 or 3 more after this.
Some years ago, one of your people was here and he said that your company, DFA, does not necessarily follow the, let us say, like a new companies going into the S&P 500 or out or whatever, something like that. If a good company is in there and you would not just sell or buy just because the rule is of the day, you know, they are no longer to be in the funds that we're invested in through you. Is that still your philosophy?
Yeah, that's correct. So I'm going to summarize if it's okay, and let me know if I get this correct there. I think what you're talking about is around an index and when companies get added to an index and when they get pulled out of an index. Now, yes, our philosophy is exactly the same because let's think about this. Who actually designs the index? It's not the index fund manager. It's not a manager like Dimensional, an asset manager. It's a third party like Standard & Poor's or MSCI or Dow Jones, and they design it and they say what goes in and what comes out. And then the managers go out and basically say, we have to strictly follow the rules set up by S&P 500 and by Dow to be an index manager so that we look like that. But what have you done? You've taken away all of your flexibility. You've taken away your flexibility of what stocks have higher returns, when I should go out there and trade them. They're going to be forced to trade certain stocks on certain days. And so at a high level, we just think that maintaining that flexibility for how we design portfolios and when we put things in or out probably adds a lot more value, and that's what we've demonstrated over time, rather than letting a third party come and say, hey, Dimensional, this is how you should manage money.
And we actually saw that with the way you guys worked with Tesla when that was added. You didn't rush out and add it just because it was going into the index, and after the price had shot up, you waited a little while and it settled down, and then you added it.
Yeah, that's right, because think about like the S&P 500 or any index. Everybody knows for the most part the stocks are going to be added. And what do you think happens to the price of those stocks ahead of them being added? They get run up because everybody knows they're going to be in there and everybody's excited to have them in the S&P 500. And so the price gets run up, and then all the index fund managers have to go out there and buy the more expensive stock on the day it actually gets added to the index. At Dimensional, we say that just doesn't really make sense to us. One, again, it's just a third party saying that this stock should be in or should be out. But two, why would I possibly want to go out there and pay a really high price to get something in my portfolio? That doesn't make any sense to us.
I am very impressed that you remembered that. Yeah. You weren't sleeping. You were listening. That was great. Good job. Anyone else? We'll take maybe two more. Lori's got you.
You knew I'd have one, Tim. Two rules we hear. For every buyer, there's a seller. And by the time we hear the news, it's old news. It's already factored in the markets. So when you have companies, major companies like Facebook, Apple, Google, any of them, they announce a stock buyback, or we're going to issue millions of new shares. Who do they reach out to in those cases? For example, like DFA, have they contacted you and brokerages like that?
Yeah, so anytime that you're going to have a corporate action of any kind, meaning I'm going to determine when there's going to be a stock buyback, I'm going to determine when a dividend's going to be kicked off, anything like that, we certainly, as any market participants, we would be ultimately notified of that. And so then you have different options on ultimately what you would want to do. There's different ways that you could handle something like a dividend. There's different ways that you could handle something like a stock buyback. If they're going to go out there and issue new shares, yes, they can work that through the same channels that they would work through for an initial public offering, and people are able to subscribe to that and go out there and buy it. Interestingly enough, corporate actions are actually a huge part of how we manage money, and you'd be surprised how much of it is going on in a given year. In fact, if you look, let's just call it the US stock market, and you said, I'm going to do absolutely no trading. I'm just going to buy every stock that's out there and I'm just going to sit on it. You would get about 3 to 4% turnover in terms of what's taking place with new issuance, what's taking place with stock buybacks, how you have to handle different dividends that are kicked off there. So there's a lot of this stuff going on all the time. You read the big headlines about it, but we're managing this every single day in the portfolios.
All right. One more, and then we're going to take our break. Does anyone else have one last question? Here comes Lori. Lori's on the loose.
I was wondering, do you know anything about I bonds? Because they were saying, on TV, I heard a number of times that the I bonds are paying 10%. Do you know anything about that?
Yeah, I'll just take this. Yep. Yeah. So I bonds are savings bonds that are designed not to beat inflation, but to track inflation. So you can buy an I bond. You can buy it directly through the Treasury at treasurydirect.gov. There's a maximum of $10,000 per person, but you can buy up to an additional $5,000, and this is an annual amount, $10,000 a year per person, and up to $5,000. If you have a refund on your tax return, you can request that to be used for I bonds as well. It's not $5,000 per person; it's $5,000 per tax return. So for a couple, that would only be $5,000. And essentially, they are made up of two variables. They have a fixed yield, and they have a variable or a fluctuating yield. The fixed yield right now is 0, but the variable or the inflation-adjusted yield currently is 9.62, and that will change again in November. Okay, it's every May and November. And when you purchase an I bond, you get that rate for 6 months. So then it adjusts every 6 months. And what causes that rate to adjust is subject to what inflation is. So they can be good. Unfortunately, you can't put a whole lot into them. And but for monies that you have that you want to earmark, say for 3-4 years or even longer, they earn interest up to 30 years. But you have to understand, it's never going to beat inflation. It's just going to match it. So when we have times like we had a few years ago when inflation was, 1 or even lower, the yields on those were very, very low. Two things you have to be aware of. You cannot cash them in for a year. You cannot. If you cash them in sooner than 5 years, you will have a 90-day interest penalty of what it earned the last 90 days. But with the way yields are right now, even if you bought one and you had to cash that in, say, in 18 months and pay the 90-day interest penalty, since the yield right now is so high, you're still going to make more in that than you would, say, in a savings account where you're earning maybe 1 to a 1.5. So, and they are tax deferred. You don't pay any taxes until you sell them, although there is an option that if you do want to pay the taxes each year, you can. So, long explanation, but that's I-bonds. All right, we're going to take our break, restroom, and are the refreshments back there? Go help yourself, and we're going to start again at 8 o'clock in about 18 minutes. Thank you.